Good morning, everyone. I'm excited to welcome you to today's presentation. We're going to explore a comprehensive guide to preparing and analyzing cash flow statements, specifically for accountants and finance professionals. The title of today's session is Mastering the Cash Flow Statement. In this presentation, we'll cover the key steps involved in understanding and managing cash flows effectively, along with practical tips for analysis. So, let's get started and dive into the essentials of mastering this crucial financial statement. Now, let's take a closer look at the different components of cash flow. Each section provides critical insights into how cash moves through your organization, and understanding these movements is key for assessing liquidity and overall financial health. First, we have financing activities. This includes cash movements from issuing shares, borrowing, repaying debt, and paying dividends. These activities show how your company finances its operations and growth. Next, we have investing activities, which involve cash flows from purchasing and selling fixed assets and investments in securities. These reflect how your organization allocates resources for future growth or divestments. Finally, operating activities encompass the cash generated from your core business operations, including sales, purchases, and operating expenses. Together, these components give a comprehensive picture of your cash flow, helping stakeholders see where cash is coming from and going to. By understanding these elements, you can better evaluate your company's liquidity and financial stability, which is essential for making informed strategic decisions. Understanding these adjustments is crucial for accurate financial reporting and analysis. When we talk about operating activities, we're referring to the cash that a business generates or uses in its normal day-to-day operations. This section starts with net income, which is the bottom line profit. But because net income includes non-cash items and other factors, we need to make adjustments. These adjustments help us see the real cash flow from operating activities. Section A, which is the core of your statement, focuses on cash from operating activities. This is an essential part of financial analysis because it shows how much cash a business is actually able to generate from its core operations. By understanding this, we get a clearer picture of the company's financial health beyond just net income. So, in essence, this section helps us bridge the gap between accounting profit and actual cash movement, providing a more accurate view of the company's liquidity and operational efficiency. Connecting this back to the overall theme, understanding these cash flows is vital for making informed decisions, whether you're a manager, investor, or analyst. Let's take a closer look at how we determine the net cash collected from customers during the period. Essentially, this figure reflects the actual cash inflow from sales activities. To calculate it, we start with the total sales revenue recognized. Then, we adjust this amount by considering changes in receivables, which can either increase or decrease the cash collected. We also account for bad debts, including write-offs and recoveries, since these affect the cash actually received. Additionally, discounts allowed to customers reduce the amount of cash collected. By combining these key adjustment items, total sales, changes in accounts receivable, bad debts, and discounts, we arrive at the net cash collected. This process highlights the importance of understanding operating activities, specifically sales and collections, as they directly impact our cash flow. Remember, these calculations help us see the true cash position of the business, beyond just the sales figures reported. Now let's look at how we determine the net cash paid to suppliers and for inventory. This is a crucial part of understanding our cash flow from operating activities. To do this, we start with our cost of goods sold, or COGS. From there, we adjust for changes in inventory levels, because if inventory increases, it means we've purchased more than we've sold, and vice versa. Next, we consider changes in accounts payable, which are essentially the amounts we owe to our suppliers. An increase in payables suggests we're delaying payments, so cash outflow is less. If payables decrease, it means we're paying off our debts more quickly. We also need to account for discounts received from suppliers, as these can reduce the actual cash paid. All these adjustments give us the true picture of cash spent on inventory and payments to suppliers. So when we calculate this, We start with COGS, then add or subtract the changes in inventory and payables, and finally factor in any discounts received. This process helps us understand the real cash flow impact of our purchasing and payment activities, which is essential for managing our operating cash flow effectively. Let's take a closer look at the changes in our short-term loans and bank overdraft facilities. These are important because they reflect how we are managing our short-term liquidity and working capital. Next, we see the section on extraordinary items. This covers specific income sources like interest income and dividends, which actually resulted in cash inflows during the period. It's crucial to understand that these are non-operational but contribute meaningfully to our cash flow. Moving on, the interest and dividends received section highlights the actual cash received from these investments. These inflows are vital for assessing our liquidity position and overall cash management. Then we have the taxes paid section, which shows the actual income tax payments made during the period. This is a key cash outflow that impacts our net cash position and must be carefully monitored. Following that, the interest paid section converts interest expenses from the income statement into actual cash payments. It's important because it reflects our real cash outflows related to debt. Lastly, the employee and operating expenses section adjusts operating expenses for changes in outstanding and prepaid expenses. This adjustment gives us a clearer picture of our true cash expenses related to daily operations. All these points tie into our overall operating activities, helping us understand how expenses and other items impact our cash flow. Keeping track of these details is essential for effective cash management and strategic planning. Now let's take a closer look at the net cash flow from investing activities. Essentially, this section reflects the cash generated or used through a company's investments in its long-term assets. The formula here is straightforward. We take the sum of sales of fixed assets and investments, and then subtract the purchases of those same assets. It's important to understand that when a company sells fixed assets or investments, it brings in cash, which is a positive inflow. Conversely, when it makes new purchases or investments, that's a cash outflow, reducing overall cash. Specifically, this includes transactions like acquiring or disposing of marketable securities, bonds, stocks, or other investment instruments. These are often short-term or liquid investments that can be quickly bought or sold. The investments also cover the sale or purchase of property, plant, and equipment, things like land, buildings, machinery, or vehicles. These are typically larger, long-term investments that can significantly impact cash flow. By analyzing these activities, we get a clearer picture of how a company's investment decisions are affecting its cash position, which ties back into our overall theme of growth and asset management. Managing these cash flows effectively is crucial for maintaining financial health and supporting strategic growth initiatives. Let's take a closer look at the cash flows from financing activities, which are a key part of understanding how a company manages its capital structure. On the outflows side, we have several important items. First, the redemption or repayment of debentures and bank loans. These are the payments made to settle long-term debts, reducing liabilities and impacting the company's cash position. Then, we have dividends paid to shareholders, which represent returns to investors and can influence investor confidence and the company's retained earnings. On the inflows side, we see the issuance of share capital, including any premiums received. This is how a company raises funds from new or existing shareholders, strengthening its equity base. Additionally, new bank loans or long-term borrowings bring in cash, providing liquidity for growth or operational needs. Other financing received can include various forms of funding, like bonds or other debt instruments. Overall, these cash flows from financing activities reflect how a company funds its operations and growth strategies, whether through debt, equity, or other financial instruments. They're crucial for understanding the company's capital structure, changes over time, and how it manages its financial leverage. Recognizing these movements helps us assess the company's financial health and strategic priorities. So, to determine the ending period cash and cash equivalents, we look at the closing cash balance. This is essentially the amount of cash the company has on hand at the end of the period. To find this, we start with the beginning period cash and cash equivalents, which is the opening cash balance. Then, we add the net cash change, which comes from the sum of cash flows from operating, investing, and financing activities. These three areas cover all the ways cash can move in and out of the business. By calculating the net change in cash, we can see how the company's cash position has evolved during the period. Finally, when we combine the opening balance with the net cash change, we arrive at the closing cash balance. This step completes the statement and provides a clear picture of the company's liquidity at the end of the period. It's a vital part of understanding how cash flows impact overall financial health and supports the broader analysis we've been discussing throughout this presentation. Now, let's wrap up with some key takeaways. Mastering the preparation of the cash flow statement is crucial because it helps us accurately assess a company's liquidity, solvency, and overall financial health. This understanding is vital for making informed decisions. Remember to include short-term, highly liquid investments, those with original maturities of 3 months or less, as part of your cash balances. This ensures you have a complete picture of your cash position. It's also important to disclose significant non-cash investing and financing activities in the footnotes, such as asset exchanges or debt conversions. These transactions can impact your financial analysis, but don't involve actual cash flows, so transparency here is key. Finally, always verify that your ending cash balance matches what's reported on the balance sheet. Reconcile any discrepancies with proper supporting documentation to maintain accuracy and credibility. These points tie directly into our overall goal of providing a clear, accurate view of financial health, enabling better decision-making across the organization.